Yeah.
Where I get back.
All right. Welcome to the multifamily deal room, our first deal that we are going to raise for. With the multifamily deal room, Cornelius runs a show usually on Thursdays to bring deals in. Cornelius Cannon. He's our ringleader. I jumped in on the investor relations side with Esther Chi and Stephen Jeffrey. And uh, I've been an investor with multifamily for a couple of years now. Really love the space, think it's a great investment, and want to share it with the world. We're going to be presenting a deal by Terra Capital today. Tom Higgins is with us, and he will do that presentation. We're going to we are recording the presentation, so we're going to let Tom run through the presentation, and then we'll take questions at the end.
Yeah, and I think I can probably streamline this pretty quickly because I think you guys are relatively, I could be wrong, correct me if I'm wrong, but I think you guys are pretty familiar with the offering at this point. So it may be valuable to dive into Q&A a little quicker than we typically would. Does that make sense?
It does, Tom. We actually have a couple people on here seeing their very first deal.
Oh, okay.
But run through the deal, and then I'll make note of some questions of some terms they might not understand or that you could clarify, and then they can ask their questions. So this will be part of their education.
Okay, sounds good to me. I just updated my Adobe, so bear with me. I have no idea how to expand screen now. Is it coming through as a minimized? Or do you see full screen?
We see full screen.
Oh, perfect. Okay, here we go. Okay, so let's talk big picture about first just our company, our thesis, how we invest, how we do projects. So I run Terra Capital with a long-term friend and colleague of mine. His name is Ray Hyman. We started actually investing in real estate while we were both in college together at Columbia University. We then worked long-term W-2 jobs to amass an investment portfolio, build our network. And then we created a real estate investment firm that focuses on two things. And you may have seen information on one of our vehicles and other marketing venues, but we do a small multifamily aggregation fund, which is a 506c offering where people invest into a fund, and then we buy sub 20 unit properties in target recession resistant Midwestern cities. We also, and it's one of my favorite parts about our company, is we also do one-off syndications in those same markets using our same network of contractors, brokers, property management professionals, etc. That we do as syndications, so ride-alongs to the fund that are over 20 units, typically below 100 units. The one I'm showing today is an amazing deal that Ray was able to source through a long-term relationship with the current sponsor of this property. We are a few weeks out to buying this. We've done our whole due diligence process. We have debt lined up. We have equity lined up. So the deal is going forward, but we are able, because of our relationship with one of our LPs, to open this up to the public if people are interested in investing alongside us. The minimum investment and a differentiator of ours is $25,000 for a subscription. This is a workforce housing deal. When you're selecting what type of investment in multifamily to be a part of, there's a lot of different considerations that you should go that should kind of go through your mind. The way we think about it, and I'm not saying there's a right and a wrong way. Obviously, I heavily believe in our strategy, but the way we like to think about it is we like to be in a very defensible position, both from a macro standpoint, but also, sorry, I got a notification on my screen. Also, specifically within the city we're in. So when I call it workforce housing, that means it's really the people who are renting this are right in line with the AMI of Indianapolis. They're the people that work in the schools. They're the people that work at the local big Walmart facility. It's kind of the defensible part of the basis of renters within Indianapolis in particular. So just to jump into some specifics, we are acquiring this. It is what I would consider a heavy value add project. We're buying it for $73,000 a door. We are putting a very meaningful amount of money into renovating each of the units. This property, just to picture it today, it's carpeted flooring, brown walls. The corridors have not been updated, and it's the last property in the Beech Grove neighborhood, which is a Class B neighborhood with 15 minutes from downtown, 15 minutes from the airport. We are putting $23,000 a door. That includes redoing the parking lot, which is one of the best ways to increase the curb appeal of a property. It also includes updating the exterior amenities. If we're the screen you're looking at right now, that's the current courtyard. We're going to improve this courtyard by doing hardscaping, by adding barbecues, by adding soft seating, etc. So I can jump into this. All told, with the cost of debt and all other fees, the total cost per door is $106,000. I covered most of this already, but just quickly, the total equity raise on this deal is 2.7 million. We are subscribed to 2.7 million, with one of our LPs providing the option for the multifamily deal room to come in and you know, kind of take out whatever portion of that we want in an effort to expand our network and provide value to people, because we want to increase our investor base. We are going to be renovating all of this to at market or above market standards, going down. The target LP returns on a 5-year hold, conservatively estimated, is a 2.1x on the money invested. We call that multiple on invested capital. And everything Terra Capital does is recession resistance first. We target parts of the demographics within recession resistant cities, and we can talk about why Indianapolis, why the Midwest is recession resilient in comparison to some of the other boom towns in America, like Austin. A little bit more background on us, and I'll just touch on this quickly, but I come from brick and mortar construction management, real estate development world. I've worked for some of the largest national developers in the United States. I work for a very large workforce housing investment fund that was sponsored by the Lennar Corporation. I've built garden style apartments in New York, New Jersey, Connecticut, and Pennsylvania. And I now run Terra's real estate development and value add and operations teams. We are located in Pittsburgh, Columbus, and Indianapolis. Majority of our larger construction relationships and trade partnerships are located in Columbus, Ohio. My business partners from Cleveland, very nearby Columbus, and we leverage those relationships to do work in Indianapolis as well as Pittsburgh, and we also have local trade relationships in Indy as well. We are doing a very similar project to the U in our small multifamily aggregation fund, about 5-10 minutes away from this property. Happy to dive into details about the U in the Q&A, but I just give you some high-level information. It's 60 units across 2 structures, just shy of 50,000 square feet, ample parking for all the residents. Whenever you're doing a workforce housing project, you want to be what we call well parked and with great visibility. The U is located really on Main Street and Main Street in Beech Grove, and it's very, very close to the largest Walmart supercenter that has a lot of other big box retail attached to it as well. So you want to be, near the grocery stores, near key foods, near Dollar General, near Walmart, but also very close to the highway and close to all the major employment centers, which this property is. We will be adding a large monument sign, which is good for all workforce housing deals. right at the corner of the property, if you can see my cursor, so you can capture the visibility from both of these main streets. This is detail about the sources and uses. We are going with a conservative financing arrangement. Bancorp is our lender. They're a debt fund, very well capitalized. In this environment, it's extraordinarily important to have good lending partners. They've committed already to doing this deal, and we are well down the line with them at this point. We are doing a bridge style loan to start, but it has a very long, it doesn't balloon really for 5 years. We expect to refinance the property after 30 months though. The rate is actually 8.6%, which is shockingly close to where you would get stabilized debt today. But because of the amount of value we're adding to each unit, it makes more sense to do this through bridge financing. We're projected 8.35% yield on cost. I always like to use this metric because it doesn't solve for rent growth and it doesn't solve for leverage. It's a very nice way to understand the yield of the asset, your total net operating income divided by your total cost. Sometimes you say your total development cost. It's a nice snapshot of how strong this deal is. Anything above 8s, and I'm sure other people in this room can say, is rare in this industry, and you very rarely can access that without a very heavy value add program like we're bringing to the table. In a high interest rate environment, having a high yield is extraordinarily important because it buffers over increasing interest rate. If you're getting debt at a low 6, mid 6, high 6, having 100 basis points or more spread over debt means that the debt is still accretive, meaning that it helps your returns. And in the world of multifamily real estate today, having deals where debt is helpful is rare. And the moment debt or your cost of capital becomes higher than your yield on cost, it inverts. And now those assets are underwater or in a very sticky situation, because real estate is a beautiful investment tool as a levered asset, because that's how you get into those teens returns. For this project, we're, like I mentioned, the 2.1x. So if you give us $1, we give you back $2 in 5 years, and we're holding that equates to a 21.6% LP annualized return. That's inclusive of the quarterly distributions as well as the total proceeds on exit. If it's valuable, I can go through the rental comps, but as I mentioned earlier, every other property in this area has been converted in the last 5 years, except for this one. It is right now and today, it is the worst house in the neighborhood. And that's whenever you're doing a value add project, you always kind of want to be in that space. You want to be in A or B neighborhoods if you can. Class C neighborhoods can work, but it's a little bit more risky, and you're going to want to see higher potential returns into the very high 20%. Our sweet spot is those Class B neighborhoods that are improving, but you can still get in at a good deal, a safer deal. This project is being marked to market slightly below the leading comp in the market. The leading comp is 140 North 9th. It is a 4-minute drive from the property, following local laws and not speeding. But we are pegging our rents slightly below that. We intend to finish our project to a higher level of finish. Beech Grove is primed to do well over the next 5 to 10 years because they've had a massive influx of investment in local hospitals, and all of these properties have been benefiting from that new job growth driver. Here's the comparable 4 minutes away from the property. The U is right here. 140 North 9th is right here. This is the finishes in 140 North 9th, very achievable with our renovation budget of $23,000 a door. Here is the exterior today. I would argue that the U today, once the parking lot is fixed and the landscape is done, is already at this level, and we're going to be adding even more in terms of the hardscaping and exterior improvements. We're also doing new exterior lighting, which is very valuable in workforce housing deals to reduce potential crime rates and also increase the curb appeal at night. You do uplighting on the monument sign so that people driving at any hour know what that property is. We're also rebranding the U, which is something whenever you're looking at a workforce housing deal that is a value add program, it's extraordinarily important that you rebrand the property when you're significantly increasing rents, and that you totally change the kind of the feel and aesthetic of both the common areas, but also the exterior. We're naming it the U because of the shape, and actually a little nod to the Colts. Here's another comp slightly below where we're pegging our rents to. This one's a little bit further from the property, about 7 minutes. They're able to get very close to our projected U rents, and they aren't even close to the level of finish we're going to have in our interiors. They still have the old kitchen LVT flooring, tile, and they haven't updated their countertops, no backsplashes. It's just dated generally. And we're going to do the nice new engineered hardwood, stainless steel appliances, quartz countertops, white subway tile backsplash. So we're going to be coming in much higher than this. This is just some quick examples of other projects that we've completed very recently, and just to get a feel for the level of finishes and type of work we've done. This is the finishes that we expect to see at the U. We are in the process of working through adding a dog run into that front hardscaped area. We've been speaking with a few different local groups and kind of getting a feel for the tenant base. This may convert more to additional hardscaping and more barbecues, and we're going to do a survey of the tenant base that we're trying to keep to see what will most benefit them in the long term. We come with plans, but we always like to react to our actual demographics and our renter base. And based off of very preliminary conversations, I think people are really excited for hardscape play areas rather than a space for their dogs. But more on that as we get into the redevelopment process. That is the high level on the U. I can stop here, or we could talk about the market in a little bit more detail. I will leave you with a few high level pieces of information that I think are pretty interesting. But when we're picking markets, what's most impressive to us is the market's resilience, not their headline news. It just so happens that Indianapolis, if you mark the last 12 months from May back, according to RealPage, had I believe it was it was the fourth best year-over-year rent growth in the United States, and beat out Miami. This report is from Yardi, November 2022. There was a more recent report released in June by RealPage that showed that they are continuing to outperform the US. And I think in any sort of uncertain market or uncertain macro environment, these submarkets that are submarkets, I shouldn't say submarkets, I mean, this market in particular, doing so well during this rocky time shows its resilience. And this is really and I'll jump to kind of my core thesis about Terra Capital and why we're in Pittsburgh, Columbus, and Indianapolis. And I'm just going to go left to right because I find this really valuable. Jonah, interrupt me if I'm going too long. I know you've heard this a few times, but I think it's really valuable for all real estate investors to consider when they're selecting markets. We never want to be chasing the news, just like stock investors. We never want to be kind of chasing the new shiny object. in my opinion, you want to be betting on markets that you're going to be very comfortable and proud to be a part of the community 10 years from now. And I think the best way to do that is to invest in what we consider as healthy markets. And health of a market kind of is driven by a handful of things, and most of them are on the page here, but I'm just going to start left to right. So just to start on the competition side, when you're investing in a market, you want to make sure that you have reliable access, especially for programs such as ours that are doing the heavy value add approach. You want to make sure that you have access to people to be able to do your projects for you. So that's the first thing. One of the first things we look for is there enough construction labor force in our submarket to do projects. A great example of the opposite of this is Salt Lake City, Utah. I love Salt Lake for a number of reasons. I'm very grateful I did not invest in Salt Lake. One of the reasons why is I felt like it was an unhealthy market because of the over competition in the market. We looked at it in 2020 as a potential investment site for us, but we tested the market out, called the contractors, called all the big players in the market, and I had some relationships from Lennar that were working on that area as well, and there was no availability for contractors. So you want to be in a market where there's not a surplus, but a healthy amount of people that are willing to work with you. What's directly correlated to that is the amount of investors in the market. You want players. You don't want to be the only person investing because your exit opportunities become very slim, but you don't want so much competition that you have to buy the property sight unseen for way more than it's worth. You want a market that's in a good place where there's 3 or 4 people bidding on every open market opportunity, but not significantly more than that. Sorry, my light just died. So Pittsburgh, Columbus, Indianapolis, for us, check those boxes. What is a result of this? Is access to higher yields. We talked about this earlier, or the yield of your multifamily project or asset is extraordinarily important in all investing scenarios, but even more so when you're entering a high interest rate environment where rates are continually going up. If you're trying to do a value add multifamily deal of this size in the Northeast and California, those yields are going to be really, really compressed. And that's connected to just historicals in the market and also the amount of competition. In the Midwest, that it provides you opportunities to access assets with higher yields. Like I mentioned earlier, we're projecting to stabilize the U in the low to mid 8% range, whereas a comparable version of this in Dallas or some very competitive market would be much lower. And just to speak on, I get this question a lot. Oh, but you're betting on appreciation. Appreciation is always related, or not always, majority of the time it is related to both interest rates and the yield of your asset. Job market stability, I would say, if not the most important, the second most important thing that we look at. We like to be in markets where the job growth in recession-resistant industries such as healthcare, education, logistics, manufacturing, these recession-resilient industries, we want to have an over-index in comparison to the US average in these job sectors. It doesn't need to be in every single one of the job sectors, but a large percent of the GDP of that location should be weighted in these recession resilient industries. And that's a nice way to forecast the stability of the market in the long term. What's really interesting is that these safe and stable markets also provide, especially that have great educational hubs like each of these cities that we invest in, and in particular Indianapolis, because of if they have strong healthcare systems and strong educational systems, that has shown over time, and we're seeing it right now, to attract new industry, new manufacturing facilities, new kind of next gen industries. People want to be in high quality of life areas if they're starting a new office or a new company, and the Midwest has been attracting a lot of this. And now I'm going to get to the kind of the crux of evaluating markets, in my opinion, and what we're really laser focused on, both from a demographic standpoint, but also from a geographical standpoint, and that's affordability. and this is very important for any multifamily developer, any value add developer. Affordability is extraordinarily important because it provides a good foundation and a safe foundation for investors to be a part of. And we call this natural affordability and not forced affordability. So there's affordable housing that's government mandated. That's not what I'm talking about. I'm talking about when a market is in a nice equilibrium where people only need to spend maybe 25, maybe 30% of their total household income on rent. In those sorts of markets, you've seen over time higher quality of life because people can save money responsibly. They can spend money on the amenities of their neighborhoods. They can socialize, etc. And that creates for a kind of a happier renter population. And what that can translate into in the inverse is an unhappy renter population. And those same people that are renting your properties are also the people that vote for political leaders. They are the constituents of a neighborhood, of a city council, etc., of a state population that can vote in leaders that promise rent reform and rent regulation. So we like to be in places that the rents are affordable naturally, where we don't have a forecast of unfavorable landlord laws. A lot of people say, I like red states because they're landlord friendly. And I would push back. And I think it's not a party line decision. It's really, can people afford to live where they want to live, or are they getting pushed out of their homes? And no matter if you're red, blue, green, if rents go up by 50% and job growth hasn't kept up, it can lead to people pushing for rent reform. And we've seen this now, we've seen this in Florida, we've seen this in Texas. So we're seeing it throughout the United States. And when you're investing in value add multifamily, where you're increasing rents 20%, 30% at an asset level to catch up to the market, if you're locked in and you can't increase those rents, it makes it extraordinarily difficult to do what you want to do. And then the last piece, and it's just important, anytime you're buying something, you want there to be a large supply of those assets that you're looking for. If you're only buying 2,000 mint and above 300 unit properties, you want there to be a lot of those in your submarket. For us, we're focused on that sub-institutional, sub 100 unit, heavy value add space. And there's a lot of those opportunities in Pittsburgh, Columbus, and Indianapolis. I think maybe it makes sense to pause here to kind of open it up to Q&A. Indianapolis is, if not the best performing submarket in the United States right now, top of the list. I think it's unfortunately becoming a less of a secret in the capital markets, and we're starting to see a little bit of a heat up in competition. But luckily, we've been investing there since 2020, so we have roots in the ground already and leads and networks in place. I think you're muted.
Can you hear me now?
Yes, I can.
All right, let's jump in and see where the questions are. Does anybody, and let's use do we have the hand raise function? We do. If you guys use the hand raise function, then we can do this in an orderly manner and not talk over people. I do have one question. You are using a term that isn't common with multifamily called stable coupon. Can you explain what that means to the investor?
Yeah. Kind of a crossover into the multifamily industry from my business partner's background. It's not a term that I typically use, but it's very simply understood as, if you buy this thing every year, what do you get as a return prior to sale? So it's, you're punching your coupon, meaning, every quarter I'm getting a check in my account, direct deposit, whatever I select. And that's what he refers to as coupon. Really your cash on cash, annual cash on cash return is another way to say it.
So you have a preferred distribution of 7.5, which means
that's correct.
You're going to pay the investor first before the team takes
Right.
any profits themselves, but you're going to try to pay them 11.5% a year.
Correct. That's exactly right.
Okay. All right. Do we have questions? Does everybody know how to raise their hand in the reactions at the bottom of the screen? Do you have any questions, guys? Tom is very versed in this. He's aware that some of this is education, so go ahead and ask your questions.
Hey, Michael.
Yes. Yeah, question. Thanks for this. This is good stuff. I may have missed it, but I wasn't sure whether there's any plan for a laundry facility in that complex.
We have
Go ahead.
2 laundry facilities in the complex. It is outsourced to a third-party management company, and there's a revenue share for
Okay.
exactly right. It is a credit card enabled system.
In the unit, in the complex.
No, we're not adding washer dryers to every unit. There's 2 washer dryer rooms, like newly renovated and in good shape.
But it's connected to the complex.
That's right. It's in each of the there's one in each of the buildings.
Got it. Okay. Thank you.
Hey,
Yep.
great question, Michael. Thank you. You ready? Carson?
It's a great question. Typically, the easiest button to press when you're doing a value add deal is to add washer dryers into every unit. There's this line that you have to be cognizant of between maybe a class, call it A- value add deal. Typically that would look like a smaller project where you're in a class A neighborhood and it hasn't been renovated in 50 years and you're buying it and you're gut renovating it and then you're building to top of the market. In that scenario, you would put washer dryers in every unit. When you're doing a large workforce housing deal, your returns are very sensitive to your per unit renovation cost, and adding washer dryer, adding the plumbing for it, etc., and having to upgrade the electric to bear the capacity on a per unit basis, conservatively estimated, let's call it $8,000 a door. Unfortunately, it's often better to do the individual washer dryer rooms and hire a third-party contractor, property manager service that maintains them as well as services them as well as provides you with direct deposits for a profit share.
Good deal. Marcia, you ready?
Good morning. My question is regarding the exit strategy. Do you ever hold the properties because they are performing really well? And if you do, how do you refinance your investors?
So we will do a refinance at stabilization. That will be about at 30 months. There will be a capital event where the proceeds are distributed to the investors, and that's part of the overall underwriting. The plan at exit, we have a handful of partners in the market that are well capitalized that are looking to buy a lot of these over the next 2 to 3 years. And we're well set up from a construction management standpoint to take these on. So what we would like to do is to put them, and this deal, all the returns I've said today are not kind of contemplated with this exit strategy, but our overarching plan is to add all of these buildings together into one very large portfolio and sell that whole portfolio to a larger institutional investor. And when you do that, you get exit cap rate compression, which then leads to higher price per door and higher returns. So that is our plan. There has been conversations about providing opportunities for people to stay in or roll over into future deals. We're not really sure what the political landscape, the laws, as well as tax laws will be in 5 years. So it's hard for us to say, but we want to be as tax efficient as possible and provide as many opportunities for people to roll over as possible. We also always contemplate where you go out to the market. And then if the investor base or LP base is still a buyer at the offers that you're receiving, then we can select to keep the property, but we want to make sure people have an opportunity to get their money back. So hope that answers your question.
Thank you.
Great question. Thank you. David, I see you unmuted yourself. You got a question, David?
Yeah. Oh, am I unmuted?
Yes, sir. You're there.
Okay. So a couple questions to piggyback on what Pasha was saying. So what dictates that 30-month refinance? Is it interest rates? What are you looking for to initiate that?
It's conservative construction schedule to turn all the units.
Okay.
We want to be over 90% redeveloped prior to going out for agency loan.
Okay. And my second question is, are you guys running a RUBS program?
Yes. We facilitate RUBS through a company called Nutility. I'm not sure if you're familiar with them, but they are a third-party reimbursement management company that's phenomenal. And you're able to put electric, water, gas. In this scenario, there's no gas, but other projects, water, sewer, et cetera. And it adds directly onto the residents' bill that they pay every month.
Thank you.
Good question, David. Thank you so much. All right, any more? If you got a question, also you can put in the chat as well. All right, Tom, you want to continue now?
Yeah, I think just purely from an educational standpoint, I think I may have mentioned this, but I just want to drive this point home. When you're selecting a workforce housing deals, right, it's a very specific strategy. You want to be in a place where you're targeting professionals that haven't saved up enough money for their first home, that are working at the recession-resistant industries within the submarket, and have great access to kind of the staples that people need within communities. When I was at Lennar, we were picking development sites. The checklist was really, the first checklist was, how's the visibility? You want to be in a good area. And if you're not in a good area, you need to be extraordinarily visible to the highway. In this scenario, we're in a Class B neighborhood of Beech Grove, and we're on the main street and Main Street within that submarket. So for me, that checks that box. The second box is proximity to employers, but also what that typically also means is proximity to big box retail. And for this, like, I think it's probably one of the biggest Walmart supercenters in America is 4 minutes away from this market, and your 15-minute drive to the heart of downtown Indianapolis. So for us, that checks that box as well. And after that, then it's really, what are you paying for it? What is the relationship between the current rents and the rents that you're achieving? What is the yield that you're projecting to stabilize? You know, how is the overall market growing? From my standpoint, with the recession-resistant conservative lens that we take as a firm, we really like Indianapolis and all of those avenues. Other than that, you know, I think it's, you know, Cornelius always asked me to put the disclaimer up front, and I always put it at the bottom, but sorry.
No worries. So, Jonah, you want to explain the next steps, Jonah?
Yes. So for those of you that are interested in learning more and if you have questions, you want to have detailed conversations, you can, if you came in through me, you know how to get a hold of me. I think almost everybody has a contact that knows how to have that immediate conversation, and then we will set you up with a link if you're interested in investing. If you're just interested in learning more about how these work, we'll do that as well.
I got a few chat. Should I check? Do you need to be accredited? Yes. Yeah. Thank you.
Oh, yeah, that, we didn't talk about, maybe we did, but I was trying to get some people on. So this is for accredited investors, but what I really like about this deal is it's a $25,000 minimum, right, which are really hard to find. And Tom and Ray have made room for us in this deal. This is an exclusive offer for the multifamily deal room investors. They made room so that we could raise in this deal. This is a good deal. Tom and Ray have a lot of experience in the smaller segment, selling off to institutional investors. I have high confidence that they'll be able to do it in this segment. I like this segment because you're not competing against the big guys in the over 100 units. And so we asked for space in this deal, and Tom and Ray were able to back somebody else off to give the multifamily deal room in this deal. I think that, Tom, if you could talk a little bit about, there's a fair amount of conservative numbers in this deal, and talk about the timing of distributions on what you're committing in the deal versus what you think that you'll be able to accomplish. They tend to overachieve on their goals.
Yeah, I can speak about our first fund. It's actually similar to our second fund. Both are value add funds. We held initial distributions after a year, and we ended up doing it in the first quarter. It's a bit of a, you want the distributions to be meaningful amount of money to make it worth it while you're still repurposing the project. Right now, the underwriting's holding the fourth quarter, similar to the way we underwrite everything, which is, I think, again, a conservative estimate. But I'm hopeful within the first 2 quarters, we'll already start giving people back their distributions. And we're holding 6.5% cap rate on exit, fully stabilized. And we're holding high 6s for refinance, which I'm optimistic will be right and or conservative, depending where rates are 2025.
And we have a couple people in here who have not experienced the joy of taxed advantage distributions. So the distributions, how well are they paired with the depreciation expense that you'll give to them?
We try to make it as close as we can to spot on.
So most or all of the distributions will be sheltered by depreciation expense. So that's I call them tax advantage, but that's tax-free income.
Yeah. The process for us is, it's a kind of a separate, longer conversation, but we do a cost seg at acquisition, and we're able to depreciate the current existing appliances and cabinets, etc. And then once we renovate the property, we're also able to do a cost seg study and depreciate the new appliances. So value add is uniquely poised to be extraordinarily tax efficient, but that's on purpose, right? You know, from a top down level, the government wants to see properties that are unrenovated renovated and brought into the 21st century. And so there's a reason for it. It's a lot of work, but it's extraordinarily tax efficient for both LPs as well as real estate investment professionals.
Excellent, thank you. All right, do we have any more questions?
I don't see one right now, but what you see on the screen currently right now is the deal room page that you probably see where you can go to right now and get more information about this deal. You can see the video. You can download the slides that he has. You can schedule a call. You kind of see an overview of what's going on about this deal here. And also feel free to actually use the chat widget right here. And you can talk to somebody directly if you have a question about it. But we got more pictures about the property. You see how the property look from different angles. You kind of see why we kind of some highlights of the deal. Kind of give a brief overview of the team as well. The leader of more about Tom and his partner Ray. Some of the next steps about what to do next. Some frequent asked questions that we kind of ask in throughout the process. So you have all here. I'll put this link in the chat again. So if you need to find out, and also we'll follow up with you with an email after this. There you go.
Yeah, so the link's in the chat. You want to bookmark that so that you can.
Yeah. So your next step is follow up with an email if you're interested, and we'll get this thing started and join us on this opportunity.
Yeah, and anyone on this call, please always feel free to reach out to me directly, whether it's about this opportunity, whether it's about how, Tom, what's your opinion on this market? Tom, what's your opinion on this? I get a lot of value from talking with other people about my favorite subject. So, don't hesitate to connect with me on different social media platforms. I'm very active on Twitter and LinkedIn. So I'm always available, and I really do enjoy it. So,
Thank you guys. Appreciate the opportunity to look over this.
Well, say what are your handles?
here, I'll just write it in the thing.
At TomTMoney.com.
Easy. Easy. All right, guys.
All right,
Thank
thank
you
you
so
all.
much. So nice meeting everybody. Have a
Thank
great
you.
day.
Bye-bye.
Have a good
Thanks,
week.
Tom.
Bye.